Welcome back, Chart Addicts. Very eventful day today. We've had a lot of market volatility. The Federal Reserve just announced a 75 basis point hike, exactly as expected this morning. In case you guys haven't checked out the previous video, make sure to check that out before this. It's a video that we dropped right before the Federal Reserve meeting, explaining some of the motivations of the Fed and some of the reasons why they were going to do a 75 basis point hike. So if you guys haven't already checked out that video, make sure to watch that first before going through this video. Now let's break down some of the most important things that happened today with the Federal Reserve's meeting. The Federal Reserve decided to take the target interest rate from 3.25% up to 4%, which is a 75 basis point increase or 0.75% increase. What this means is that despite the long run narrative that the Fed may pivot during this Fed meeting, pivoting meaning changing their central bank policy, we saw that the Fed remained hawkish through this news and that their target to fight inflation and bring inflation down to that long run target of 2% was still their main priority. So because of this, we're expecting markets to remain on that trajectory for the long term. Let's explore some of the main things that happened during the Federal Reserve's press conference today and see if we can break apart some of the main points that Jerome Powell mentioned as he was going through his speech. So what we have in front of us here is the Federal Reserve's press release. This comes out right before the press conference. And so this basically gives an indication of what the Federal Reserve is planning on doing during the press conference and some of their intentions as it relates to the interest rate and some of these other important central bank policy. What we saw in the report that came out is that the target federal funds rate rose from 3.25% up to 4%, and that the committee seeks to achieve the maximum employment inflation rate of 2% over the long run. And so what they're doing is they're reiterating this point that their main priority is to bring inflation back down to that 2% target, which means that they're going to have to go tighter for longer in order to bring inflation back down. When they continue to reiterate the 2% number, what it shows is that they are committing to a target that is almost impossible for them to reach in the short term, which means if the Fed wants to save their credibility, they're going to have to continue to go tighter for longer in order to maintain this trajectory. And so everyone who's expecting a Federal Reserve pivot, we can't really have a pivot as long as the Federal Reserve is insisting on this 2% inflation target. A very interesting thing that we saw here is that in addition, the committee will continue reducing its holdings of treasury securities and agency debt and agency mortgage-backed securities as described in the plans for reducing the size of the Federal Reserve's balance sheet. So basically, whenever the committee is reducing its holdings of treasury securities, someone has to buy these treasury securities off of the Fed. This can either be some of the large commercial banks that are part of the Federal Reserve System, like you could say Bank of America or JP Morgan or one of those larger banks, or they can actually go to the Treasury and have the Treasury buy back these securities themselves. Most likely, they're going to go into the open market and they're going to sell these treasuries to banks and force them to give the Federal Reserve cash, which means that although they're reducing the size of the balance sheet holdings in terms of securities, they're going to get capital reserves in exchange. And so the Federal Reserve is still maintaining some sort of growth during this period. So a very interesting thing is that they mentioned it more than once, that the committee is strongly committed to the inflation target of 2%. This is something that we mentioned in one of our previous videos that we talked about the Federal Reserve's dilemma. The dilemma is as long as they continue to promise this 2% inflation, the further and further we get from the possibility of a short run recession, and the more that the likelihood is that we're going to see a longer term, longer run recession that may stretch into 2024. Now, the one piece of hope for all the Federal Reserve pivot crowd is when they keep insisting that the committee will continue to monitor the implications of the information, the economic outlook, and something that Jerome Powell has become very famous for is the mention of being data dependent. Being data dependent means that they're very strict about their trajectory and their goals until the data suggests otherwise. So long story short, if we're just going to sum up what this Fed meeting means, this is essentially the same tone the Federal Reserve has had the entire year, which is basically that they're going to continue to tighten monetary policy until they reach that longer term goal of 2% inflation. And if they can't reach that 2% inflation naturally, they're going to send us into a recession to crush demand so that all prices come back down. And so this just basically confirms that the Federal Reserve is planning on continuing this tightening policy well into 2023, and we're most likely going to see a deeper, longer run recession as a result of these tightening policies. Overnight repurchase agreements are basically a loan between central banks and between banks to each other, and they're saying that they can only limit it to $500 billion with a bid rate of 4% for those overnight loans. But of course, that $500 billion limit can be increased at the discretion of Jerome Powell. So we're not going to go into each individual policy that the Federal Reserve has outlined in this release, honestly, because it might take too long in this video. We'll probably just do them in other videos. But the majority of the decisions that the Federal Reserve makes is just essentially boils down to how much the Federal Reserve is going to lend to other banks and how much the banks are going to have to pay in order to borrow from the Federal Reserve. The biggest piece is that the Federal Reserve is intending on reducing their balance sheet going into the next few years. Because of the pandemic, the Federal Reserve has bought so many securities from the open market in order to provide liquidity to the market. So the Federal Reserve will essentially buy securities from these major banks and provide liquidity to the market in the form of cash. Now that the Federal Reserve is trying to reduce inflation, their job is to reduce the velocity of money and to reduce the amount of supply of money in the system. A great way to do that is to return some of these treasury-backed securities and these mortgage-backed securities to these commercial banks and have the commercial banks give the central bank money instead. When the central bank has a large balance of reserves from these commercial banks, it makes the central bank a lot more stable, it makes it more solvent, and it releases a lot of the pressure from the market in terms of how much inflation has built up. So if you guys go through the next few months, you'll realize that the Federal Reserve is going to continue their hawkish tone going into next year. So to go ahead and sum this up, it's been a very volatile day for the markets, but essentially everything came as planned. We have a 75 basis point hike from the Fed. Jerome Powell is not as weak as everybody says he is. So while everyone was expecting a dovish pivot, instead we got a very hawkish release, and we're expected to remain hawkish into the December 14th Fed meeting. And so there's plenty of data points between now and the next Fed meeting. We have NFP this week, we have unemployment rates, we have the CPI data, we have GDP data going into that next release. And so up until December 14th, the Federal Reserve has plenty of data points to decide whether they want to remain hawkish or end up pivoting into a more dovish stance. Stay in touch and make sure you guys hit that like and subscribe to stay on top of all the market news. Look forward to seeing you guys again. This is Roy from Chart Addicts. Take it easy. Peace.